Welcome back. In this video, we're diving deep into SEBI's Listing Obligations and Disclosure Requirements Regulations, 2015, one of the most exam-critical topics for CA final law. Whether it's compliance timelines, related party transactions, or the role of a compliance officer, SEBI LODR tests your ability to recall specific numbers and conditions under pressure. So we've structured this revision to be crisp, logical, and exam-ready. We'll go regulation by regulation, covering every detail you need. No fluff, just the facts that fetch marks. Let's get started. Think of Regulation 5 as the accountability umbrella. A listed entity cannot just sit back and hope everyone complies. It is actively responsible for ensuring that its KMPs, directors, promoters, and anyone dealing with the entity fulfills their assigned obligations under the regulations. And it doesn't stop there. These persons must proactively disclose all relevant information to the listed entity so the entity can stay compliant with applicable laws. In short, the obligation flows both ways. The entity ensures compliance, and the individuals ensure transparency. This two-way accountability is the foundation of the entire LODR framework. Regulation 6 is very specific. Only a qualified company secretary can be appointed as the compliance officer. But that's not all. 3 conditions must be met simultaneously. 1. They must be a whole-time employee, not part-time or contractual. 2. They must be designated as a KMP. 3. And this is the hierarchy rule. They must be placed not more than 1 level below the board, meaning 1 level below the MD or whole-time director. If there's no MD or WTD, then not more than 1 level below the CEO, manager, or whoever heads day-to-day affairs. Remember, proximity to the board is non-negotiable. When a compliance officer's position falls vacant, the clock starts ticking. The vacancy must be filled at the earliest, but within 3 months. Now here's the catch. The entity cannot fill it on an interim basis unless the interim appointment meets all conditions of a fresh appointment. During the vacant period, at least 1 full-time KMP must manage day-to-day affairs. Special case, if a resolution plan under Section 31 of the Insolvency Code is approved, the 3-month clock starts from that approval date. As for duties, ensuring regulatory conformity, coordinating with the board, and monitoring the grievance redressal email. Simple but critical responsibilities. Regulation 7 gives listed entities flexibility, but not freedom. They must either appoint an external share transfer agent or manage transfers in-house, but both options come with conditions. If they go external, the agent must be a SEBI-registered Category Y or II registrar and transfer agent. No random vendor qualifies. If they go in-house, they must ensure their internal systems meet SEBI's operational benchmarks for transfer processing. The regulation doesn't force one option, but it firmly ensures that whatever path is chosen, investor interests in seamless share transfers are protected. No shortcuts allowed. SEBI doesn't wait for year-end to check if listed entities are on track. It demands quarterly accountability on 3 key fronts. First, grievance redressal under Reg 13.3. File a statement on investor grievance redressals. Second, corporate governance under Reg 27.2. Submit a compliance report within 30 days from quarter end. Third, shareholding pattern under Reg 31. 1. This one has 3 subtimelines: 1 day before listing, within 21 days from each quarter end, and within just 10 days if any change exceeds 2% of total paid-up share capital. That 10-day trigger for capital restructuring is a favorite exam question. Don't miss it. 2 more critical quarterly submissions. Under Reg 32.1, if a company has raised funds through a public, rights, or preferential issue, it must submit a statement of deviation or variation showing where the money actually went versus where it was supposed to go, category-wise, quarterly. No escaping this one. Under Reg 333, quarterly and year-to-date standalone financial results must be submitted within 45 days from the quarter end, except the last quarter. Now, the insolvency exception. If a Section 31 resolution plan was approved during a particular quarter, the financial results for that quarter can be disclosed within 90 days instead of 45. That's double the time. But only once. When the financial year closes, listed entities get 60 days to submit their annual audited standalone financial results, the audit report, and, if there are modified opinions, the statement on impact of audit qualifications. That's Reg 333. For the annual report under Reg 34, it must be submitted to the stock exchange, uploaded on the website, and a copy must be dispatched to shareholders along with the AGM notice before dispatch even begins. If any amendments are made post-AGM, the revised copy plus explanation must reach the stock exchange within 48 hours of the AGM. 60 days, 48 hours. Remember both. Regulation 29 is about fair disclosure to the market. Before certain board decisions, the listed entity must give at least 2 working days advance notice to the stock exchange, excluding both the date of intimation and the date of the meeting. And the notice must explicitly mention the meeting date. What triggers this? Buyback of securities, voluntary delisting, fundraising activities like FPO, rights issue, QIP, ADR, GDR, or debt instruments, declaration or recommendation of dividend, issue of convertible securities or debentures, and declaration of bonus securities, but only if bonus is part of the agenda papers. One exception, RBI-regulated instruments like securitized debt are exempt. The logic is simple. Material decisions must reach the market before they're made. 2 more timeline-based rules. Record date under Reg 42. When the entity fixes a record date for dividend, rights, or bonus issue, conversion of securities, mergers, splits, or any other corporate action, it must give minimum 3 working days notice, excluding both the date of intimation and the record date itself. Website updates under Reg 46. Any change in website content must be updated within 2 working days. These may seem minor, but SEBI treats timely disclosure as investor protection. A wrong record date or stale website could misdirect thousands of investors. So yes, 3 days for record date, 2 days for website. Both are tested in exams. Both matter in practice. Before we get to approvals and thresholds, let's nail the definitions, because if you can't identify a related party, nothing else matters. Under Reg 2(1), ZB, a related party includes anyone defined under Section 276 of the Companies Act, 2013, any promoter or promoter group entity, and any person or entity holding 20% or more equity shares. But from April 1, 2023, this threshold dropped to 10%. A related party transaction under Reg 2(1), ZC, is any transfer of resources, services, or obligations between the listed entity or its subsidiary and a related party, regardless of price. From April 1, 2023, it also covers transactions that indirectly benefit a related party. Exceptions, preferential issues, and uniform corporate actions like dividends, bonus issues, and buybacks. Here's where numbers matter. A related party transaction becomes material and requires shareholder approval when it crosses certain thresholds. The general threshold is whichever is lower, 1,000 crore rupees or 10% of annual consolidated turnover. For brand usage or royalty payments, the bar is lower, 5% of annual consolidated turnover. Why? Because royalty transactions have historically been misused to siphon value. Now for SME exchange-listed entities, effective April 1, 2025, the threshold is 50 crore rupees or 10% of consolidated turnover, whichever is lower. 3 different thresholds, 3 different scenarios. The exam loves asking which one applies. Know them cold. Under Regulation 23, no RPT can happen without prior Audit Committee approval, and crucially, only the independent directors on the committee can approve. Not the executive directors, not the MD, only independent directors. Now, for repetitive transactions, the committee can grant Omnibus approval, valid for 1 year, subject to quarterly review. The Omnibus approval must specify the name of the party, nature of transaction, period, maximum amount, and the base price or formula. For unforeseen transactions, Omnibus approval can be granted for up to Rs 1 crore per transaction. That's the cap, not per year, per transaction. If it exceeds that, you need specific approval. No blanket passes beyond 1 crore. For material RPTs, Audit Committee approval is not sufficient. Shareholder approval is also mandatory. And here's the critical rule. No related party can vote on that resolution, whether or not they are directly a party to that specific transaction. The disqualification is broad by design. Now the exceptions. 3 situations where shareholder approval is not required. 1. Transactions between 2 government companies. 2. Transactions between a holding company and its wholly owned subsidiary, provided accounts are consolidated and shareholders have approved. 3. Transactions between 2 wholly owned subsidiaries of a listed holding company. Same conditions apply. Insolvency exception. If a Section 31 resolution plan is approved, shareholder approval is waived, but disclosure too. Regulation 24A mandates secretarial audit for every listed entity, and not just the listed entity alone. Its material unlisted subsidiaries incorporated in India are also covered, so the compliance net extends beyond the parent company. Who can conduct this audit? Only a peer-reviewed company secretary, not just any CS, a peer-reviewed one. That's a higher bar. And where does the report go? It must be annexed to the entity's annual report, making it publicly accessible to all shareholders and regulators. 3 things to remember: listed entity plus material Indian subsidiaries, peer-reviewed CS, and annual report annexure. That wraps up our revision of SEBI LODR Chapter 3. All the best for your exams. Welcome back, everyone. In this video, we are doing a deep dive into one of the most important and marks-heavy topics in CA Final Law SEBI regulations. We will cover 3 big areas: secretarial audit, the LODR committees, and the ICDR framework for capital market issues. Whether you are revising for the first time or your 5th, this video is structured so that every concept clicks, sticks, and stays. Let's get into it. Let's start with the big picture. SEBI runs 2 major regulatory frameworks. First, LODR, the Listing Obligations and Disclosure Requirements, which sets governance standards for companies already listed on stock exchanges. And second, ICDR, the Issue of Capital and Disclosure Requirements, which controls how companies raise money from the public. Think of LODR as the ongoing rulebook for listed companies, and ICDR as the entry rulebook when they first open their doors to investors. Both work together to protect investors and maintain market integrity. Now, who exactly can conduct a secretarial audit? Only a company secretary in practice or a firm of practicing company secretaries. But there's a catch. They must be a peer-reviewed company secretary. This means they hold a valid peer review certificate directly issued by the ICSI, the Institute of Company Secretaries of India. This applies whether the CS is an individual practitioner, a sole proprietor, or a partner in a peer-reviewed practice unit. The purpose? Quality assurance. SEBI wants to ensure the audit is done by someone who has been evaluated for professional standards. How long can a secretarial auditor be appointed? Here's the rule. Appointment is based on the board's recommendation and requires shareholder approval at the AGM. For an individual CS, the maximum is 1 term of 5 consecutive years. For an audit firm, the maximum is 2 terms of 5 consecutive years each. So an individual gets 5 years total, while a firm gets up to 10 years in total. The key number here: 5 years per term. Write it down, remember it. The Audit Committee is the most important governance committee under LODR Regulation 18. Minimum 3 directors must be members, and at least 2/3 must be independent directors. All members must be financially literate, but that's not enough. At least 1 member must have actual accounting or financial management expertise. The chairperson must be an independent director and must attend the AGM to answer shareholder queries. The company secretary acts as the secretary to the committee. One special exception: if the company has SR or superior voting rights shares outstanding, the entire committee must consist only of independent directors. Owing to the operational rules of the Audit Committee, it must meet at least 4 times a year, and the gap between any 2 consecutive meetings cannot exceed 120 days. For quorum, you need the greater of 2 members or 1/3 of the total committee strength, with a minimum of 2 independent directors always present. Now, the powers: the committee can investigate any activity within its terms of reference, seek information from any employee, obtain outside legal or professional advice, and even secure attendance of external experts. These are strong, sweeping powers, and rightly so. The NRC Nomination and Remuneration Committee, under Regulation 19. Minimum 3 directors, but here's the key difference from the Audit Committee. All members must be non-executive directors. At least 2/3 of them must be independent directors. The chairperson must be an independent director. Now, an important special note for exams. The chairperson of the listed entity can be a member of the NRC, but they cannot chair it. The NRC must meet at least once a year. Quorum is the greater of 2 members or 1/3, including at least 1 independent director. The Stakeholders Relationship Committee exists for one clear purpose: to protect the interests of shareholders, debenture holders, and all other security holders. Regulation 20 requires a minimum of 3 directors, with at least 1 being an independent director. The chairperson must be a non-executive director, and unlike some other committees, They are mandatory attendees at the AGM to personally address security holder queries. The SRC must meet at least once in a financial year. Simple composition, focused mandate. The SRC is the voice of investors inside the boardroom. The Risk Management Committee under Regulation 21 doesn't apply to all companies. It is mandatory only for the top 1,000 listed entities by market cap and for high-value debt-listed entities. Composition, minimum 3 members. The majority must be board directors, and at least one must be an independent director. Senior executives can also be members. The chairperson must be a board member. Important exception: if SR equity shares are outstanding, at least 2/3 of the committee must be independent directors. This committee essentially oversees the company's entire risk landscape, including cybersecurity. The Risk Management Committee must meet at least twice a year. The maximum gap between any 2 consecutive meetings is 210 days. Note this is different from the Audit Committee's 120-day limit, so don't mix them up. Quorum: the hire of 2 members or 1/3, with at least 1 board member present. The committee's role is defined by the board and must specifically include cybersecurity oversight. This is a mandatory requirement under Part D of Schedule 2. Powers include seeking employee information, obtaining professional advice, and securing attendance of external experts, identical to the Audit Committee. What happens when a company violates LODR regulations? The consequences are serious. The entity and responsible persons become liable under general securities laws. Beyond that, stock exchanges can take specific actions as directed by SEBI. These include imposition of fines, suspension of trading in the company's securities, freezing of promoter and promoter group holdings of designated securities, done in coordination with depositories, and any other action specifically mandated by SEBI. The message is clear: LODR compliance is not optional. Non-compliance hits both the company's market standing and the promoter's control. Now we enter the ICDR territory: how companies raise capital. Under SEBI ICDR 2018, a public issue can be an IPO, initial public offer, where an unlisted company offers shares to the public for the first time. It can also include an offer for sale by existing shareholders. An FPO, or follow-on public offer, is when an already listed company comes back to the public for more capital. A rights issue is when a listed company offers new shares exclusively to its existing shareholders, as on a record date. 3 distinct types: IPO, FPO, rights issue, all regulated differently. Beyond public issues, there are more routes. A composite issue is when a listed company simultaneously raises capital through both a public issue and a rights issue. Allotments happen at the same time. A bonus issue is free shares given to existing shareholders, funded from free reserves or share premium. No cash changes hands. Then there's private placement, restricted to a maximum of 50 persons or up to 200 in a financial year. For listed companies, private placement takes 2 forms: preferential issue, which is for select persons or groups but excludes ESOPs and sweat equity, and QIP, which stands for qualified institutions placement, offered exclusively to qualified institutional buyers or QIBs. Not every company can walk up and file for an IPO. SEBI Regulation 5 lists who is barred. If the issuer, its promoters, promoter group, directors, or selling shareholders are debarred from capital markets by SEBI, no IPO. If a promoter or director is linked to another debarred company in a similar capacity, no IPO. Willful defaulters and fraudulent borrowers, barred. Fugitive economic offenders, barred. And if there are any outstanding convertible securities entitling someone to receive equity shares, barred, with limited exceptions for ESOPs and stock appreciation rights. 1 relief: if a past debarment has already expired by the date of filing the draft offer document, that restriction doesn't apply. If a company passes the eligibility screen, it must also meet 3 hard financial thresholds under Regulation 6.1, all based on restated and consolidated financials. 1. Net tangible assets of at least 3 crore rupees in each of the preceding 3 full years. And not more than 50% of those assets can be in the form of monetary assets. 2. Average operating profit of at least 15 crore rupees over 3 years, with operating profit in each individual year, no averaging out a loss year. 3. Net worth of at least 1 crore rupees in each of the preceding 3 years. All 3 must be satisfied simultaneously. What if a company can't meet those financial thresholds? There's an alternative route under Regulation 6.2. The issue must go through book building, and the company must commit to allotting at least 75% of the net offer to QIBs, qualified institutional buyers. If that 75% isn't achieved, the full subscription money must be refunded. Separately, for companies with superior voting rights or SR shares, they can only IPO ordinary shares on the main board if very specific conditions are met. The business must be tech-intensive, the SR shareholder net worth must be under 1,000 crore rupees, and the voting ratio for SR shares must be between 2:1 and 10:1. Beyond eligibility, Regulation 7 sets the operational groundwork before an IPO can happen. The company must get in-principle approval from at least one stock exchange. All promoter shares must be in DAMAT form before filing the offer document. Firm financial arrangements for at least 75% of the stated project finance must be in place, excluding the proposed IPO proceeds. Now here's an important cap. The amount earmarked for general corporate purposes, or GCP, cannot exceed 25% of the total funds raised. And combined, GCP plus amounts for unidentified acquisitions cannot exceed 35% of total funds raised. In an offer for sale, existing shareholders sell their shares to the public. But SEBI has a condition. Those shares must have been fully paid up and held for at least 1 year before filing the draft offer document. What if the shares came through conversion of convertible securities? SEBI is fair here. The holding period of the original convertible security and the resultant equity shares are clubbed together to calculate the 1-year period. However, the actual conversion into equity shares must happen before filing the final offer document. The red herring prospectus or prospectus and full disclosure of the terms must be made. And that's a wrap on this entire module. Secretarial audit, all 4 LODR committees, LODR penalties, and the full ICDR framework from issue classification to IPO eligibility. The key to mastering this topic is numbers: 120 days, 210 days, 3 crore rupees, 15 crore rupees, 75% QIB, 25% GCP. Lock those in first, then build the logic around each one. If this video helped you, hit like, subscribe, and keep revising. CA Final is tough, but with the right structure, it is absolutely crackable. All the best.
Welcome back, everyone. Today we're diving deep into one of the most exam-critical chapters for CA Final law, SEBI's ICDR regulations. We're going to cover offer for sale rules, convertible debt and warrants, promoter contribution, and lock-in periods. Now, these aren't just theory. SEBI designed each of these rules for a very specific reason: to protect investors and keep capital markets honest. So let's break it all down, clearly, logically, and in a way that actually sticks. Let's go. Before we jump in, here's your roadmap for today. 3 big zones. First, offer for sale rules, including the 1-year holding period and its exemptions. Second, alternative eligibility under Regulation 8A, and the rules for convertible debt and warrants. Third, promoter contribution and lock-in. Think of this like a 3-act story. Each act builds on the previous one. By the end, you'll see how all these pieces connect into one coherent regulatory framework. Ready? Act 1 begins now. Here's the foundational rule. If you want to offer equity shares for sale to the public, you must have held them for at least 1 year before making that offer. Why 1 year? Because SEBI wants to ensure that promoters and early investors aren't just flipping their shares at the IPO stage for a quick profit. It signals genuine, long-term commitment to the company. Think of it as SEBI saying, if you believed in this company, prove it. Stay invested for at least 12 months first. Simple, logical, and powerful. This is your base rule. Now let's look at where exceptions apply. Now the 1-year rule has 3 important exemptions, and each one makes complete sense when you think about it. First, government companies, statutory bodies, and infrastructure SPVs controlled by them. These entities serve public interest, so the restriction doesn't apply. Second, shares acquired under court or tribunal-approved schemes, provided the business existed for more than 1 year before the scheme was approved. Third, bonus shares issued on securities held for at least 1 year. But here's the critical condition. The bonus must come from free reserves or share premium NOT from revaluation reserves or unrealized profits. That restriction prevents artificial inflation of share value. When an issuer files under the alternative eligibility route under Regulation 6.2, meaning they're relying on QIB allotment, additional restrictions kick in for shareholders wanting to sell via OFS. For major shareholders, those holding more than 20% of the pre-issue fully diluted shareholding, the rule is, you can sell a maximum of only 50% of your pre-issue holding. And here's what makes it stricter. Standard lock-in provisions fully apply to these shareholders, with 0 relaxation allowed. So not only are you capped on what you can sell, You're also locked in on what you keep. SEBI essentially says, big shareholders must have skin in the game even after the IPO. Now for the other side. Shareholders holding less than 20% of the pre-issue fully diluted shareholding. Their cap is different. They can offer a maximum of 10% of the issuer's total pre-issue shareholding. And this isn't calculated in isolation. It is cumulative, meaning it includes both the current public offer and any secondary sales that happened before the issue. The reference date for calculating all this? The date of filing the draft offer document. So no moving the goalposts later. The calculation is fixed at filing. This ensures that even smaller shareholders don't collectively offload excessive stakes before the company goes public. Here's something many students miss. An issuer can launch an IPO of convertible debt instruments even without a prior public issue or equity listing. That's significant flexibility. But there's one hard eligibility condition. The issuer must not be in default on interest or principal payments on any public debt instruments for more than 6 months. So if you've defaulted even on a single instrument for more than 180 days, you are disqualified. This 6-month rule is SEBI's minimum creditworthiness filter. It ensures that issuers approaching the public for debt capital have at least demonstrated basic financial discipline. No clean record, no issuance. Simple. Beyond eligibility, a convertible debt IPO comes with 4 mandatory compliance requirements. Think of these as the 4 pillars of a legally sound debt issuance. 1. Obtain a credit rating from at least one SEBI-registered rating agency. 2. Appoint at least one debenture trustee to act as a watchdog for investors. 3. Create a debenture redemption reserve, which is essentially a safety net fund for repayments. 4. Redeem the instrument strictly as per the terms in the offer document. No deviation. These 4 together create a framework of accountability. You're raising money from the public, so you owe them structure, oversight, and certainty. Now, if the convertible debt is secured, which means it's backed by physical assets, additional rules apply. The assets must be sufficient to cover the principal at all times, and must be free from encumbrance. If a prior charge already exists on those assets, the issuer must get consent for a second, or pari passu charge from the existing lender. That consent must be submitted to the debenture trustee before the issue opens. And here's the key calculation rule. Asset cover is computed after deducting liabilities that already carry a first or prior charge. So the unencumbered cover must stand on its own, net of all senior obligations. When convertible debt is due for conversion into equity shares, SEBI mandates positive, explicit consent from the holders. Silence is not consent. Non-receipt of a reply is not construed as agreement. The holder must actively say yes. Now there's an additional protection for larger issues. If the convertible portion exceeds 10 crore rupees, and the conversion price was not determined upfront, then holders must be given an explicit option not to convert. This opt-out right is non-negotiable in such cases. The only exception, if an upper price limit and its justification were already disclosed in the offer document. In that scenario, the opt-out obligation doesn't apply. Oh, what happens when a holder exercises their right not to convert? The issuer is then obligated to redeem that portion of the debt. And the timeline is strict. Redemption must happen within 1 month from the last date of the option window. The pricing rule is equally clear. Redemption price must be greater than or equal to the face value of the instrument. This protects the investor. You opted out, you get your money back, and you don't lose on face value. However, this redemption obligation doesn't apply if the redemption terms were already disclosed upfront in the offer document. Prior disclosure removes the mandatory trigger. Here's one of the most important restrictions in convertible debt law, and it exists to prevent a very specific type of abuse. Funds raised through convertible debt instruments cannot be used to finance, give loans to, or acquire shares of promoter companies or group companies, unless the conversion period is less than 18 months from the issue date. Why? Because if the instrument converts within 18 months, the promoter group benefits are short-term and relatively contained. But if conversion happens later, beyond 18 months, allowing funds to flow to promoter entities creates a serious conflict of interest. SEBI draws a hard line here. Public money must not become a long-term source of promoter group funding. Warrants are instruments that give the holder the right to subscribe to equity at a predetermined price. Under Regulation 13, warrants issued in an IPO come with specific conditions. The maximum tenure is 18 months from the date of allotment. Multiple warrants can be attached to one specified security. The price or formula must be determined upfront. No ambiguity. And crucially, at least 25% of the consideration, based on the exercise price or the cap price of the price band, must be collected upfront. Now here's the critical forfeiture rule. If the warrant is not exercised within 3 months of the consideration payment date, that upfront money is forfeited. Exercise your warrant or lose your deposit. Under Regulation 14, promoters must hold at least 20% of the post-issue capital. This is the bedrock of promoter accountability in an IPO. And here's the nuance. This 20% is not calculated on simple share capital. It's computed on expanded capital, meaning you assume full conversion of all convertible securities and exercise of all vested ESOPs and SARs. The only company exempt from this requirement is one that has no identifiable promoter at all. For every other issuer, 20% is the minimum. This rule ensures that those who built the company continue to have a meaningful stake after it goes public, keeping their incentives aligned with the shareholders. What if promoters can't reach the required 20%? SEBI offers a limited safety valve. The shortfall, but only up to a maximum of 10% of the post-issue capital, can be contributed by specific institutional investors without them being classified as promoters. Who qualifies? AIFs, FVCIs, scheduled commercial banks, public financial institutions, insurance companies, promoter group entities, and any non-individual entity holding at least 5% of the company. This is a carefully curated list. SEBI doesn't open this bridge to just anyone. These are sophisticated, accountable investors. So the rule maintains the spirit of the 20% requirement while allowing a structured, regulated mechanism for shortfall coverage. The timing and holding of promoter contribution is equally regulated. Promoters must satisfy their contribution requirements at least 1 day prior to the issue opening, and the funds must be sitting in a designated bank escrow account. They can only be released alongside issue proceeds. Now, there's a special rule for large contributions. If the minimum contribution exceeds 100 crore rupees, applicable in cases of partly paid shares, at least 100 crore rupees must be brought in before the issue opens. The remaining balance must then be paid on a pro rata basis before each public call is made. The escrow requirement ensures the commitment is real, not just a promise on paper. In the special case where a company is issuing convertible debt without having ever made a prior equity public issue, an additional set of contribution rules applies. Promoters must contribute at least 20% of the total project cost as equity, and additionally, they must fund at least 20% of the issue size from their own funds. Both conditions must be met. If the project is being implemented in stages, the equity contribution must be proportionate, matching the total equity participation relative to the debt raised at each stage. This rule ensures that promoters aren't using public debt as the primary funding instrument, while putting in minimal equity skin of their own. Now we reach lock-in, the rule that keeps promoters tied to the company post-IPO. The minimum 20% promoter contribution is locked in for 18 months from the date of IPO allotment. That's the standard period. But here's the extension rule. If the majority of the issue proceeds, excluding OFS component, is designated for capital expenditure, the lock-in stretches to 3 years. Why the extension? Because CapEx projects are long gestation, the market needs promoters to stay committed until the project actually delivers returns. So SEBI ties the lock-in horizon to the nature of the investment. Longer the productive use of funds, longer the lock-in. Very logical. What about promoter shares held above the 20% minimum? These excess holdings are locked in for a shorter period, 6 months from the IPO allotment date. But if majority proceeds are for capital expenditure, this too gets extended to 1 year. So the CapEx rule adds a layer of commitment across all promoter holdings, not just the minimum. And then there's a special category, SR equity shares, or superior rights shares. These remain locked in until they convert into ordinary voting equity shares, or until the standard lock-in period is complete, whichever comes later. SR shares carry extra voting power, so SEBI ensures they remain restricted until that power is normalized. Alright, let's close with your exam day cheat sheet, the numbers you absolutely cannot mix up. 1 year minimum holding for standard OFS. 20% minimum promoter contribution, calculated on expanded capital. 18 months, lock-in for minimum contribution and maximum warrant tenure. 6 months, clean record required for convertible debt eligibility, also the lock-in on excess promoter holdings. 1 month, mandatory redemption window when holders opt out of conversion. 3 months, forfeiture deadline for unexercised warrants. Know these numbers cold. In application-based questions, SEBI examiners test whether you can apply the right threshold to the right scenario. Revise these, and you're exam ready. All the best.